I'm going to go ahead and get started. Thanks so much for joining us today. My name is Emily Sprenger. I'm an academic trainer in the Center for Teaching and Learning, and I'm very happy here to have Dr. Aaron Brown joining us today for his webinar presentation, The Catastrophe That Was Not, an exploration of the 2020 stock markets and expectations for the future. So Dr. Brown has mentioned that he wants you to be able to engage in conversation, so the chat is open. And please ask any questions that you might have in the Q&A section of the Zoom. And then just as a general reminder, this is going to be recorded and posted in our CTL webinars page for future reference, or for those that registered today that couldn't be here at the specific time. So without any more of my conversation happening, I'm going to turn it over to Dr. Brown, and enjoy, everyone.
Awesome. Emily, thank you so much. Thank you for the invitation to explore this very long-winded title. I think I would have avoided this webinar if I'd seen all those syllables on the marquee. So thank you so much, Emily. I'm just going to share my screen real quick, and we're going to do just some diving in. And as Emily said, the catastrophe that was not, an exploration of 2020 stock market and expectations for the future. So, got some key dates here that we want to focus in on from March of 2020. For those of you who are not aware, I know this is going to sound crazy, and it's not going to make any sense, but the whole world went through a pandemic last year, and it was called COVID-19. I guess it's still called COVID-19. And there were just some really wild things that happened. Businesses were asked to pause in operation. Toilet paper went flying off the shelves. There was a toilet paper shortage, at least here in America. My brother, who lives in South Korea, he called me over Facebook Messenger and was like, "Why are you guys out of toilet paper?" And I'm like, nobody can figure that out. If anybody is able to figure that out, that may be the $1 billion question. But our key dates: Monday, March 9th, Thursday, March 12th, Monday, March 16th. And the reason that these are key dates is these are the days that the Dow took the biggest plunge it's taken almost in 3 decades, more like 2 decades, a little over 2 decades. And so on Monday, March 9th, it was the largest Dow Jones Industrial Average drop to that date. And then on March 12th, it was another record-setting drop. And on March 16th, still another record-setting drop. These three represented the worst point drop in U.S. history. More than the Great Depression, more than Black Monday in 1987, more than the 2008, what we saw with the 2008 financial crisis. So in those 1 to 3 days, worst point ever. So the question is, what caused the drop? Now everybody's like, wait, I know the answer to this. Well, 3 causes that were kind of happening at once, and that's the coronavirus. The second is oil was dropping fast, and the fear of a 2020 recession. Those 3 things were playing key major roles in the Dow Jones losing so many points. So real quick, we want to visit Black Monday, because Black Monday was the last time things were this bad. So on October 19th, 1987, the Dow Jones Industrial Average dropped 22.61% in one day. Now that's significant if you're taking notes. You just might want to jot that down, 22.61% DJIA. The last time it had been that bad, or worse, I should say, was December 12th, 1914, with a 23.52% drop in the Dow Jones. So, probably would be good for us to answer the question, what is the Dow Jones Industrial Average? So, sometimes this is abbreviated to DJIA. If you visit Yahoo Finance or any website that discusses trading platforms or market indices, this is what you'll see, DJIA. And this is a market index that tracks 30 large publicly owned blue chip companies. So blue chip companies being kind of cream of the crop. There's a certain market cap of how many shares they are trading volume wise. And DJIA trades on the New York Stock Exchange as well as the NASDAQ. The DJIA, Dow Jones, was founded in 1896 by Charles Dow and Edward Jones. So you may be familiar more with the name Edward Jones because of the personal financial planning firm. So Dow and Jones set the market index to serve as an indicator of the market's vitality or lack thereof of the U.S. economy. So we might say that the DJIA is actually a benchmark index of how well our economy is performing or how poorly our economy is performing. And they do it with these 30 blue chip stocks. So when the DJIA originally formed, it only had 12 companies in it. And the market sectors that it had included railroads, cotton, gas, sugar, tobacco, and oil. If the DJIA is strong, we believe it's an indicator that the economy is strong overall. If the DJIA is weak performing, then it likely indicates a slowing economy. So companies that are included in the DJIA, when those companies are perceived to be more relevant to the current trends of the economy, they are added to the DJIA, and companies that are considered less relevant are pulled off. And so a company that's pulled off is replaced by a better relevant or more relevant indicator of where our market is. So example, we're going to use the S&P 500, which is another market index of S&P 500, Standard & Poor 500 is an index of 500 stocks. So on December 21st of 2020, the S&P 500 added Tesla to their stock index because they believe that is a relevant company that will help with the benchmarking of how well our economy is doing. And so Tesla, who did they replace on the S&P 500? They replaced a REIT, which is a real estate investment trust company. Maybe some of you invest in REITs. It's a very easy way for you to buy shares in real estate without spending hundreds of thousands of dollars to buy individual properties. So on December 21st, the S&P 500 added Tesla and took off the REIT, Apartment Investment and Management Company. So that's who the S&P pulled off. And then on the S&P 100, which is another index, Tesla replaced Occidental Petroleum Corp. And so when I was double checking that, I realized that years ago I'd met the grandson of Occidental. And so that has nothing to do with this presentation. I'm just humble bragging that I met the grandson. So it's neither here nor there. But so the composition of the Dow Jones. So when we look at DJIA, these are some of the companies that are represented. So Caterpillar, if you're familiar with equipment, farm equipment, backhoes, bulldozers, things like that. That's Caterpillar. Johnson & Johnson, which is a little bit more in the news because of the COVID-19 vaccine. JP Morgan Chase, United Health, Verizon, Honeywell, Home Depot, and the list goes on. Let's see. So just a few more final thoughts on the Dow Jones Industrial. Again, it is an index. It's a collection of stocks that are averaged against each other, has an algorithm, and benchmarks how well we think the economy is or is not doing. And we would sometimes we would call this a basket of securities, just a side note, you can actually use indexes similar to how DJIA uses it, or S&P 500, and you can track interest rates, inflation, manufacturing output. There's a lot you can do with indexes. So if you'd like to invest in the Dow Jones Industrial Average and you're like, well, I can't dump tons of money into buying each individual stock. Well, Vanguard, and I'm not promoting any type of mutual fund or anything like that. I'm just saying, if you would like to do that, one place that you can check out is Vanguard, and they have an ETF, or electronically traded fund, that emulates the Dow Jones. So that fund holds a collection of those 30 stocks, that basket of securities. And I will make my notes for this presentation available so that you can, there's 2 or 3 links that I've left throughout these notes. So I'll make those available to you. So just popping back, Black Monday. We want to come back to Black Monday. And this is the day the DJIA lost 22% in a single day. Okay, now spoiler alert, on March 9th, the DJI did not lose 22% in a single day. So it was not as bad as Black Monday. So on Black Monday, this marked a global stock market decline all around the world. By the end of the month, most of the major exchanges had dropped more than 20% in their percentage value. So there was lots of panic selling, which means people are like, I don't want to lose any more money. I'm selling now. So they're just dumping everything that they can. And the cause of Black Monday was there were a lot of geopolitical events. We're probably, if it's 1987, I believe we're on the heels of, it's October, so we're on the heels of the Berlin Wall falling. And then there was also the advent of a computerized program that sped up the sell-off. So people were using this program, and it just made things worse for the stock market. So we had ourselves a little 2020 timeline. And let me just say, I am incredibly simplistic with my slides. And part of that's out of laziness. The other part is I'm a huge fan of Guy Kawasaki and his approach to putting slides together. And so I'm just trying to put the most relevant information out there to you without boring you with a ton of information. So, let's get back to the 2020 timeline. On Monday, March 9th, the Dow fell 2,013.76 points. Okay. So it fell from 25,864.78 points to 23,851.02. Big number we want to focus in on, 2013 points. Okay, so percentage-wise, the Dow fell 7.79%. That's not 20% in one day, okay? Remember that on Black Friday, it fell 22% in a single day. So on March 9th, was this the worst thing that had ever happened for the stock market? No. But it definitely hurt. So I knew one person, they called me, and this was after probably about a month or two after, and they panicked. I think they lost $200,000 because they panicked over these 3 dates that I've already given you, and they pulled their money out. And the sad thing is that they owned a lot of Tesla. So if if you know the end of the story and you know how well Tesla has done in the last 18 months, then 12 to 18 months, then you're like clutching your chest just a little bit. You're having a little bit of trouble breathing because you just realized how much this person missed out on. So, but when it comes to this, to what happened in the market, what people get fixated on is that the Dow fell over 2,000 points. Now, one thing we have to remember or keep in mind, and I know this sounds very negative, but it's not, because it's human psychology. The market is driven by fear and greed. Make sure, fear and greed. And so, maybe we could temper that a little bit with optimism, but generally it's driven by fear and greed. When the market takes a 2,000 point hit, people think that's a lot. And so the human imagination kicks in. Things could get worse. I'm going to pull my money out now. My cousin, she called me and was like, freaking out. Oh my gosh, I've lost all this money in my 401k. Should I cash it out? No. If there's anything you walk away from today, the answer is no. Do not cash out your 401k. We saw somebody do that in 2008, or we saw people do that in 2008, and the market more than came back. Like, people would have got all their money back and much more if they just left their money in their 401k or mutual funds, or either one of those vehicles that they have their money parked in, maybe an IRA. But do not pull your money out. And we can talk about a few other things later as we work through this. But big thing was psychological factor, 2,000 points. So when it rains, it pours. And on March 12th, 2020, the Dow fell more than 2,000 points, more than 2013, 2,352 points. And it closed at 21,200 points, a 9.99% drop. So after those 2 days, the Dow fell a collective 17.78. Is that still as bad as one single day Black Monday? No. But we're getting pretty darn close to Black Monday records at this point. Then on March 16th, the Dow lost 2,997 points. It closed at 20,188 points. It dropped 12.93%. Now at this point, we're over Black Monday percentages. Some people might say, eek, this is a problem. Because on February 12th, about a little less than a month before this, the Dow reached its high of 29,551 points. And by March 9th, the Dow lost 5,700 points, or 19.3%. If the Dow had hit 20%, the event would have signaled a bear market, which ultimately it did signal a bear market. So real quick, we just want to talk about a bear market. So what is a bear market? Well, this is when the market experiences prolonged price declines. And this can be, typically this is when securities fall 20% or more from recent highs. So that's what we saw. Eventually, that's what happened. There's also a psychological mindset among investors where they believe that the fall is going to continue to happen. The market will continue to be bad. So this continues to drive the bear market. And typically, bear markets go along with economic downturns like a recession. So if the market continues to drop enough over a prolonged period of time, we're headed towards a recession. So since we've talked about bear market, we need to talk about its arch nemesis, the bull market. And bull markets, on the other hand, is a state of where prices rise or are expected to rise. Usually, the bull market is associated with the stock market, but you can also apply this to bonds, real estate, currencies, commodities. So, I mean, one thing we might say is if you've noticed, we are in a bear market of real estate all across the US. Prices have risen everywhere. I live in beautiful Colorado Springs, Colorado, and the market is absolutely ridiculous out here. People from New York, and not so much New York, definitely California, but California and New York, those states have started to empty out. New York is at the lowest New York City, I should say, and even New York State to some degree, is at the lowest population that it's been in 15 years. And we'll talk about that a little bit more. But bull markets last for months, years. Before the bear market of March 9th, 12th, and 16th, and bear markets don't have to last very long. We had been in a bull market since 2009 when the economy started to recover after the financial crisis. So, just know that when there's a financial crisis, there's typically only one way from down, and that's up. So I was working through my MBA at the time when the financial crisis happened. It was a good time. It was a great observation time, and stocks fell really low. I did really well with General Electric stock back in the day because I was buying it for about $5 a share. And then I think when I sold it, I sold it several years ago actually, but I sold it at about $55 a share, something like that. So we've been in a bull market since 2009. And with the financial crisis of 2008, the only way is up. And the Federal Reserve is likely responsible for artificial influence on the economy, especially after 2008, because they were purchasing mortgages and certain securities. But I would say we were really in a bull market since Donald Trump won the presidency of 2016. Now, that is not a statement of a better presidency, less presidency, but again, it was a market psychology behavior. People had a greater optimism with a perceived conservative president and business guy in the White House, and so things just began to take off, really take off. At least that that bull market seemed more demonstrable. So another psychological effect of in the market is that we see with like commodities like oil prices. So if you remember in 2020, I called a friend of mine who's in the oil industry, and I was like, my gosh, what's going on with oil? And he said, Aaron, we will go below $20 a barrel. The market will it through its psychology to hit $20 a barrel. The reverse actually happens as well. That if I remember a few years ago, oil was perceived to break 50, 60, 70, 80. I think it got up to 90 with the particular season that I am remembering. But it was the market purely willing those prices to happen, and it happened. Actually, during the time when during COVID-19, the collective psychology of the market pushed oil to almost negative numbers, if not negative. Like oil was worth less than the barrel it was stored in. So let's take kind of a quick Q&A break real quick, Emily. If there's any questions that have popped up, it's probably be a good time to tackle any.
Yeah, feel free to post any questions in the Q&A. There was some stuff in the chat about the housing market.
Sure.
And how you've talked about that. Someone just had mentioned that houses where they're at are like very expensive
Yes.
compared to what they used to be. And I was
Yes.
sharing that experience as well too when selling my house in Arizona.
Oh,
I
yeah.
sold my house in Arizona 2 years ago. I still have people contacting me to see if I'm selling my house in Arizona.
That's funny.
But one of the questions that I have in the Q&A is, can you please tell us what are the best stocks or shares a person can buy or invest in?
No.
Okay.
No.
Fair.
We will get to a segment. I do want to be real careful about any recommendations or
Right.
thoughts. Because I'm not a financial advisor, nor am I bound by any of those regulations about giving out my opinion. But I definitely don't want people running out and saying Dr. Brown said such and such, and now
Yes.
I mortgaged my house 3 times based on his recommendations. But we will talk about a few stocks, and then as far as I remember, what we'll focus in on is what industries are expected to take off, especially in Q3 of 2021. So we'll definitely do our best to get to that. So
that is a completely fair answer, Dr. Brown. Let me see.
Long-winded.
Although I love the question. I was like, wonder if
A great
he's gonna. Yes.
Great question.
One question in the chat is, do you have any indicators in a bear bull switch?
Bear bull switch. Okay.
Are there indicators that might happen to know that switch is going to happen?
Yeah. So typically what you want to look at are rates on bonds. So if you've taken any classes with me in any of the financial classes, typically what people want to look at is what are the curves that are happening in the tails with bond yields, rates, things like that. And usually those they can be leading and lagging indicators of where the market is headed. Also, inflation. Inflation tends to be one of the big indicators of how the market is going to perform. I think something that's a little unprecedented right now is that our federal government is very involved with managing our inflation rate. So I was reading an article this morning that the Fed is doing everything they can to keep inflation and some other things at 2%, which makes everything a little more manageable. So I would say look at those 2 things as indicators. But as we can see, there probably weren't a lot of indicators in that very brief bear market of March saying, oh yeah, everything's going to flip upside down. We'll be in a bear market and get our 10,000 points back. Like it was wild. So
other contributing factors as well too, right?
Absolutely.
And things that we can't necessarily predict.
Exactly. Well,
right.
who knew that Zoom was going to 500% in value or 1,000% in value? Nobody knew. If you were holding that stock, I knew somebody who owns Zoom stock, and I was like, why? Why would you own Zoom? But if you were holding it, a pandemic was a great time to be holding Zoom stock. So.
And I know this is taking you off topic,
No,
but it does make me wonder whatever happened to Skype and why did Zoom get more popular than Skype did? But we don't have to talk about that now, but it does make me wonder.
I think just very simply, I think Skype's user interface was too difficult and it wasn't intuitive. I think Zoom has a much more intuitive, so that's more of, a geek entrepreneurship, design thinking approach, but I think Zoom's just much more intuitive than Skype. So.
All right, thanks, Dr. Brown. That's it for right now in the Q&A.
Awesome. Let's jump back to the Dow. As you can see in this chart, these are the 10 biggest one-day point losses in Dow Jones history. As you can see, the majority of those 10 biggest one-day point losses happened in 2020, all but 2 of them. But let's take that with a grain of salt. Point losses aren't everything. And the reason we want to take it with a grain of salt is that, sure, the Dow fell 20.3% when it closed on March 11th, down from its February 12 high. So bear market, boom, bulls over. And we get the handy dandy chart that we have on the slide. On Black Monday, the Dow fell 22.61%. The points lost, just guess. I was joking around the other day. I'm the guy that's real good at guessing how many M&Ms are in the jar. That's probably not true, but just to yourself, just guess real quick. How many points did the Dow lose on Black Monday? Okay, 508 points, but that was 1987. So the Dow had a lot fewer points to work with at that time. What did it close at in 1987? 1,738 points. Guys, we were at 30,000 points in 2020. Think about that. So percentages is more of what we want to pay attention to, not so much points, if that makes sense. Let's see. So the stock market crashed on October 28th, 1929, which plunged us into the Great Depression. It plunged 12.82%. That would not necessarily be an indicator of a bear market or a depression. The points that it lost, 38.33. What did it close at? 260 points. So this began the Great Depression. So we can see how 3 big days of losses and an end to a bull market in the midst of COVID-19 and the unknowns would create the perception that we are going to enter another Great Depression. But as you gathered from the title, this was the catastrophe that was not. And so ultimately, the crash occurred because investors were afraid of COVID-19, as they should be. All the epidemic, the unknowns. But President Trump also had trade wars against China that were making investors jittery, and farmers, farm rolls, things like that. We're not happy with President Trump over this. And I think, honestly, probably all the willing and dealing that he could do wasn't going to solve this when you're dealing with a major foreign power like China. We also saw investors demand higher returns on treasury bills when the March 9 numbers fell. And when investors sold their stocks, they turned to invest in bonds, which drove down yields to record lows. So the bond market is getting saturated. People are wanting to put their money in safer vehicles until brighter, sunnier days. So because the market had lost so much in those days, investors saw their 401ks, their retirement, drop. Told you the story of my cousin. Should I pull out? No, don't do it. Don't do it. Don't pull your money out. So how long do bear markets last? We'll just revisit that real quick. Well, it's about 22 months at the most. Some as short as 3 months. What else happened? Well, since consumers wanted more treasury notes, this lowered yields and ultimately impacted the lowering of interest rates for auto, school, and home loans. So key in on that, home loans. You could buy a much more expensive house and pay almost the same as you're paying for your less expensive house. So let's, hold on to that thought and then answer the question, was there a recession in 2020? Yes, but it didn't last long. Sure, we saw ridiculous. Okay, let me qualify this. Most of the time, I try to not make personal philosophical statements. I'm more of a classical liberal. And so, so I might say that I think there was some ridiculous, arbitrary government overreach in some instances. I say that as someone who has an affinity for classical liberalism. And the reason I say it's arbitrary is because the government picked who could and could not be open. And a lot of this was due to very successful lobbying by big chain industries. So the Costco, Sam's Clubs, the McDonald's, fast food eating franchises, who benefited from this overreach. They benefited from this overreach. There's nobody to represent the little guy or little gal that is that's running their small business. And so, you know, like many of us, we saw where a McDonald's was able to keep its drive-through window open. But we also saw where our favorite mom and pop restaurant or bodega in New York City, I have family in Brooklyn. So, you know, there's things to me that are very salient and near, like the bodega didn't get to stay open, but man, Costco got to stay open. And we saw their, you know, their shares and values go up. And so I think this was an example of corporatism by the federal government. And personally, I just don't think it should have happened. But enough about what I think. And then I also think that you know, we were under the auspices of flattening the curve, which I think was necessary. But suddenly we began arbitrarily choosing what could and could not operate. So I think it made sense to all of us that grocery stores could stay open, but construction was still going. It became an essential service. But I think that this created a lot of confusion for the small business owner and for the average consumer. And I think it created a lot of chaos for a lot of people. So let's see. Okay. So I think, so yes, there was a recession in 2020. One thing experts agree on is that the US Federal Reserve did prop up our economy. However, bond yields remained low. And this may indicate that a return to economic normalcy may still be a good ways away. You know, I think the other thing that we would add is we did inject liquidity into the market during this time. And so this also left people with cash on hand. Now, we recognize that there are particular populations and demographics that suffered during this time. But what we do know is that out of surveys conducted by several companies and organizations, we found that 1 out of every 3 Americans basically saved their stimulus check. And even with the second or third round that came up, what was expected of consumers to do with their second stimulus check? It was, I'm going to pocket it. And so, you know, we see some challenges with that. We do see a little bit of spending. I mean, people that, you know, if they have like 2, 3, 4 kids, they ended up potentially getting close to $10,000 in stimulus money. So that's a lot of liquidity in our economy. A lot of it was getting sat on, and we'll revisit that here in a second. So we had the steepest, quickest bear market decline ever, only 16 days to lose 20%. It was the highest volatility on record, which hit a high of 85.47 on the Chicago VIX. And oil went almost below $0, just kind of doing a quick recap. Which stocks performed the best? I'm going to try and like blister through this because I know I got about 5 minutes left, 5 to 10 minutes. But Tesla was obviously one of the great winners. There's an article or a quote from a guy named Wood who said, let's see, I was wrong about that, who said Tesla only generates profits at present by selling tax credits. And tax credits are payments to Tesla by other auto manufacturers who make too few electric vehicles to satisfy regular. So every car company manufacturer in America has a finite amount of carbon credits. And so what Tesla was able to do, because they are an auto manufacturer, they are able to get these credits as well, but they don't need the credits because they're an electric car company. So they don't, use the same type of manufacturing. So they actually sold their credits for a profit to the other auto manufacturers. We see the same thing with wind turbines. The only way that investors make money off wind turbines is through the government subsidies that are given. Now, we can argue whether that's good, bad, short run, long run. That's not really my point. But Tesla would never have been able to stay afloat without those tax credits and being able to sell their carbon emissions. So in this respect, as noted in an excellent article in the Wall Street Journal in August, the irony is that Tesla is worth more than most of the industry it relies on for the subsidies that are the only reason it's been able to report 5 consecutive quarters of profit. Now, Tesla is actually now turning substantial profit if you look at their SEC filings, 10Ks. But for a long time, they didn't. And the only way they stayed, or one of the, I shouldn't exaggerate, one of the only ways they stayed afloat, or at least cash flow positive, was through the selling of those emissions. Other winners, Etsy. If you like arts and crafts or buying things from custom things from people, Etsy. NVIDIA, semiconductors. PayPal, which is data processing, and L Brands, which is an apparel footwear company. Those were like the big winners of 2020. Real quick, Robinhood. Robinhood is a exchange trading platform. It's got about 13 million users since 2016. It launched in 2013 with a free trading model, and it has outperformed the Charles Schwab's, Fidelity's, and TD Ameritrade's. Right now, as of like May of 2020, it had 200 mil, or May of last year of 2020. It has 280 million of fresh capital, boosting its valuation to 8.3 billion. And so a quick quote from its co-CEO, maybe former co-CEO, I think something changed in the last week or two. We've seen a major paradigm shift for broader financial services. People that previously didn't feel like the markets were for them are for the first time feeling a sense of inclusivity. The median age of a Robinhood app user is age 31. So maybe in some ways it made day trading efficient. Robinhood is definitely a gamified platform. And if you're not familiar with gamification, that's basically back in the day, Starbucks used to give you gold stars for buying coffee, and you felt better about spending money on terrible coffee. So, I'm sorry, that was my opinion again. But they kept you coming back by giving you gold stars. Some of you have apps on your phones that basically bring you back because it makes you feel like a winner. So Robinhood is good at that. And then this other quote, new investors who sense a generational buying moment but do not have much background in the equity space see a shift. We have heard anecdotally about younger individuals with less market experience viewing the March plunge of 2020 as a unique time to start portfolios and often crowding into the tech arena, purchasing the stocks whose services or products they know and use. And that's exactly right. Like March was a great time to get into the market. You know, we've all heard buy low, sell high. You sell high, you buy low. So it was a great time. How does Robinhood work? Well, it uses arbitrage. If you're not familiar with that, basically it's catching the difference between two kind of different areas. So if I'm selling an apple over here for $1, but I live in a place that's selling apples for $2, and I'm going to go over here and buy a bunch of apples for $1, come back over here and sell them for $2. Eventually, this place over here will catch on and start raising their prices. So that's kind of how arbitrage works. And so Robinhood basically has firms that trade shares buy the rights to engage in arbitrage on the behalf of Robinhood, and they can determine what a customer is going to buy shares for. So the big point is I think Robinhood disrupted the industry, especially with fractional shares, the ability to not have to buy a whole share of stock, especially if it's expensive, like the Amazons or Facebooks or Googles of the world. Um, and they just disrupted the industry and made things very different and more accessible for a younger audience who has received stimulus checks and have a little bit more play money to mess around. Now, there's been some downsides to that. Many of you may be aware of the young man who woke up, uh, saw that he was over 700,000 in the hole. It was a glitch on the part of Robinhood. It was not accurate. And he ended up taking his own life because he thought he owed $700,000 to Robinhood. So there's been some back and forth on that and what that means. But again, Robinhood has disrupted the industry. They're outpacing traditional competitors like Schwab, E-Trade. And then, at the end of 2020, the Dow finished the year up 7.2%. S&P 500 did better. They gained 16.3. And, the hot thing of 2020 was technology stocks. And lots of people were trading options. And, it was just kind of a roaring time, as we all kind of sat and watched this happen, had no idea where it was going. So, I think some quick recap: stimulus injections of $1,200, huge. Feds cut their rates to zero, almost zero, not zero, but almost zero. We see people leaving very expensive markets like California and New York City because remote work becomes the norm. And it's like, why in the world would I live in a place that's so expensive if I can live somewhere else? And so we've seen new housing go up. We've seen prices skyrocket on homes. And a lot of the similar stuff happened in 2008. And what I mean by that is with bailouts. So I remember when Bank of America, everything crashed in 2008, and Bank was trading at, I think, about $1.25 a share. And that would have been a great time to buy, especially after the government bailed out the banks. And so consumer confidence shot way up and the market started driving. And at one point, B of A was trading for, I think, $20 a share or something like that. And at the end of the day, the Fed has definitely signaled that we're going to run the printing presses like a house of fire. I asked friends and colleagues who are in investing in personal finance, like, hey, do you think we're going to see a market correction? I use the word crash initially, and there's not going to be a crash for a long time. I think correction is definitely a better word. And the reality is that psychologically, our country is still in a fragile state, and elections still loom over the House and the Senate here in another 18 months. And so I think we're going to continue to see some type of liquidity injections over that. Tech was huge in 2020. Netflix was up 64% because what else were you going to do? Amazon was up 70. Tesla was up 700%. 700%. Somebody may ask what industries might perform well. Let me just jump over to this slide real quick. Pharma, IT technology, we'll see tech slow. We'll see that continue to slow. Steel, chemicals, leisure travel, not business travel, but leisure travel. And I think anything telecommuting is going to perform well. Projections for commodities, so things like oil, soybeans, gold, even lumber. There was a projection last year that lumber prices would finally go down after quarter 1, and that did not happen. And there is no shortage of lumber. So there is some type of artificial pricing because of demand, houses being built, things like that are driving prices up. We see something similar with cattle. Cattle prices are low, cattle prices are high, beef prices are high, but there's tons of cattle out there and the farmers are not getting probably what they deserve, what's owed to them. But by quarter three to quarter one of 2021, we should see commodity prices overall decline. So I'm going to stop sharing my screen. Emily,
I am here.
let's hit me with some questions. And I realize I've gone over time, so
totally fine. It's totally fine. We still have like about another 9 minutes, but
okay.
I could not stop laughing on your Starbucks comment. That was hilarious.
Because it's true. That's why.
Couple of questions. I've got three questions for right now. Someone in the chat wants to know, do you think interest rates will one day rise?
I mean, that's an easy one because everything rises, everything falls. So that's an easy slam dunk answer. The question, when will interest rates rise? I think it's going to be a good while. I mean, I think everybody was shocked about a month or two ago when rates rose to 2.9 and then I think dipped into 3. I just purchased a house yesterday, and so I was not happy when interest rates rose up to 3. So you guys are just learning all kinds of things about my life, but they will go up. But I think the question is when and what purpose will the Fed play in that? So I think what we also have to understand is that with Donald Trump's presidency, and this is not a good or bad value claim statement, we saw a very different president that we're used to. I mean, he's almost like that Theodore Roosevelt bully pulpit type president. And I mean, he was kind of willing the Fed to do whatever he wanted out of them for the most part. And so it'll just be, I don't see anything going differently with a Democratic president. I think that there's going to be a push to keep rates low, keep inflation in check a little bit. From what I read, today or yesterday, 2.2% inflation, that's very manageable. So yeah, they'll go back up maybe 5 years from now.
I won't hold you to that, but I do understand that it absolutely will.
Let's do it now,
up.
Emily. $50. $50
right?
5 years from today. That $50 will be worth.
Meet me right here on Zoom.
Right.
Okay. Right. A couple of questions in the Q&A. Penny asks, what is a good resource to use to find companies going public?
Oh yeah. Market Watch, Yahoo Finance, Wall Street Journal. I mean, most of these are free. So, especially if you have, you have access to the NCU library, you can pull up anything. I think Wall Street Journal. So, so yeah. And then I would just Google companies going public in 2021. So, like for instance, I'm always forgetting when companies are going public, and something I want to pay attention to. And so Coinbase went public 2 weeks ago, and I'd set my TD Ameritrade account to buy some Coinbase, and then it just came out hot, like hotter than what they estimated. And so I was like kicked out of it and wasn't able to purchase it. But yeah, any of those resources, I would say just Google.
Absolutely. Thank you for that. Dr. Brown, one question here that I think probably other people are just curious about as well too, but is from an anonymous attendee. Where can you buy stocks and shares? Oh,
Robinhood, TD Ameritrade, E-Trade. There's tons of platforms out there. What it really depends on is your comfortability with that platform.
Is there a platform that might be more user-friendly for someone who's an inexperienced trader?
Sure. I think it's worth a shot to try out the Robinhood app. I have some philosophical differences with them, especially over the GameStop incident. The incident. That's what we'll call it, the incident. But I think Robinhood would probably be one of your better launching points. And I think it just depends on, are you trying to buy stock for the long haul to invest, or are you looking to do some day trading? And day trading is definitely not for the faint of heart. It's not anything that I do. So I would just throw that out there.
Okay.
Someone just said Webull is a good platform, so maybe that's something you might want to check out. I use TD Ameritrade personally.
Okay. Oh, thanks, Penny, for that. That's in the chat. Another question in the Q&A. How disruptive to the market are sites like Reddit when they are recommending short squeezes, and how trustworthy are they?
Yeah, so I think it was absolutely ridiculous, here's my opinion again, to pin this on Reddit. Reddit was able to mobilize a group of investors to do what was in their best interest. And sure, it was a squeeze. It, took, I think, 2/3 liquidity out of a particular hedge fund. And the outrage that came about from Wall Street and came about from our politicians was uncalled for. And it is not those things were not in the best interest of the free market. So what I mean by that is big players in sectors want corporatism. They want more laws. And the reason is, let's use Philip Morris, for example. Philip Morris is a tobacco provider. They actually do want their segment more regulated with more laws because it keeps out smaller players from entering the market. So what you saw with Wall Street and these hedge funds is that they started crying out for more regulation to stop the little guy from being successful and making money, becoming millionaires. And so the problem is that these guys are in politicians' pockets and funding them. So that's why politicians are like, we've got to do something. We've got to do something. At the end of the day, if you're the little guy, what do you care about, large spreads of volatility? You don't. You should be able to play in the market at your own risk. But I'm a classical liberal. So was it disruptive what Reddit did? Yeah, absolutely. Was there anything unethical about what they did? Absolutely not. It's just they took billions of dollars from a hedge fund that made a bet, was a little too public about it, and they got in trouble. So happens to the best of us.
And then just a follow up on the Reddit question. Do you see more trading regulation coming because of Reddit?
I think it'll probably die down for now. What I'm uncomfortable with is platforms like Robinhood starting to make these new rules about trading and volume and things like that. So I think Reddit froze GameStop, specifically with this question, froze GameStop for 24 to 72 hours. And philosophically, I just disagree with it. But for now, no. I think actually what we're going to see is there's several politicians on the right who have basically said, we need to come together as a group of politicians and quit taking money from big tech firms like this. And so I think that will become the new conversation instead of let's legislate more.
All right, well, thank you for answering that, Dr. Brown, and thanks for answering all of the questions. I want to thank everybody for coming to today's webinar, and thank you again, Dr. Brown, for your expertise and sharing some of your opinions, I'm sure, with us today. And just a brief reminder, it's recorded and will be posted in the CTL webinar LibGuides page for your viewing pleasure. And I hope everybody has a great rest of their day. Take care.
Thank you so much, Emily.
Bye-bye.